Welcome to Turning Hard Times Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the first day of October 2019. I do like to remind you that I'm the author of Jay Taylor's Gold, Energy, and Tech Stocks. It's a company that's a newsletter that focuses primarily on junior exploration companies, and the gold has gotten hit fairly hard the last couple of days, last week or so, and a lot of the shares have gone down as well. I think it's an excellent time, if you believe as I do that we're in a long-term bull market for gold, an excellent time to take a look at some of these exciting stories that I talk about every week in my letter. I'd like to also encourage you to go to chenpicks.com to sign up for my friend Chen Lin's letter, What is Chen Buying, What is Chen Selling, especially if you're interested in biotechs and some things other than gold and silver and the exploration stocks. Chen covers them too to an extent, but he has really done very, very well with the biotechs, has made a lot of money for his subscribers and in his own account. Also like to always have you think about Michael Oliver, olivermsa.com. We'll be talking to Michael in just a moment. Want to thank all of you for listening to this show, making it one of the top shows in the Voice America Business Channel. Always encourage you to send along any comments you might have about this show to questionsfortaylor@gmail.com, questions, the number 4, Taylor@gmail.com, and last but not least, we want to thank our sponsors for making the show economically viable. Our sponsors for this week's show are Novo Resources and Great Bear Resources, two of my favorite companies, I might add. Well, I've titled today's show China or the USA. Alistair McLeod, Dr. Quentin Henning, and Michael Oliver return. The title of today's show, and much of what I hope to cover, is derived from an essay Alistair wrote on September 5th. In providing an overview of the article, he wrote the following in the opening paragraph, and I quote, "China has made some silly errors in its conflict with the U.S., reflecting the arrogance that often afflicts every state actor. But the appearance that China is being backed into a corner over Huawei, trade tariffs, and Hong Kong is misleading. China is progressing her own plans, and they do not require an accommodation with America. With Russia in tow, she is now the chief foreign influence for up to 3/4 of the world's population. So it is American hegemony that's being backed into a corner. One day, this will be reflected in a currency shootout," end of quote. So when we talk to Alistair in the second half of today's show, I want to find out what he thinks the dollar might look like after that shootout takes place, what might trigger a shootout, and given the outlook that Alistair sees for the dollar, then I want to ask him what advice he might have for us, of course. What should we do in planning, not only financially, but perhaps in other ways, if we get to that. Dr. Quentin Henning will join me after our first commercial break. Well, you talk about another favorite gold exploration stock that I own and that I cover in my newsletter. And I'm not talking about Novo Resources, not today anyway, although that remains a top pick of mine. I expect to have Dr. Henning with me for an update on Novo in the near future, I think in a couple of weeks from now, perhaps. Quentin is the leading geologist, however, for Irving Resources, and he sits on the board of directors of that company, Exploring for Gold in Japan. It is a company that is it's my second largest holding. So, of course, I'm very interested in what Dr. Henning will have to say about Irving Resources. Right now, I'm happy to tell you that Michael Oliver is with me once again to provide his latest thoughts on some of the markets that are most important to us. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you, and I missed you last week. We were, my wife and I were in Portugal taking care of some business, a little bit of a vacation. But I always, I need my Michael Oliver fix every Tuesday, so I'm really glad you're with me. On September 29th, you put out a commentary on gold and silver, and actually you did an update again today, which I haven't had the chance to look at today. But talk to us a little bit about what you see for gold. I know a lot of nervous Nellies out there that watch the price charts and not your momentum work that get a little bit scared when they see gold going down. And then if they own the shares, sometimes those shares go down percentage-wise even a lot more than gold. But what are your latest thoughts on gold now?
Well, back in early September, we put out a report that finally said, okay, if you want to take some profits, go ahead and take some if you're nervous. But we suggested make sure it's partial because this bull trend's not over. But at least then, with gold having reached 1550, we saw enough reasons to say, okay, they could have a congestion zone or a pullback. Okay. We thought the pullback might find support, and again, we're in the 1500s when we put this out, around 1485. Well, it happened to drop just above 1485 a week or two later, stopped, rallied. Next week came down to 1484, stopped, rallied. And last week went down to 1485 area again. Well, that's probably too many times coming down to what we thought might be support. And the floor broke. The floor broke. And it broke yesterday hard. You finally broke below 1485 and followed a little bit more today down into the 1450s and then whipped back up. And the reason, of course, for the rally is the manufacturing news, which suggests that now the Fed has another metric by which to, justify further rate cuts, et cetera, et cetera. And that was our main argument recently in that first report you mentioned is instead of looking at gold's technicals right now, which everybody does, look outside of it, at least three other major markets, dollar index, Bloomberg Commodity Index, and the S&P 500. Those markets have not justified the gold advance we've seen, which is a 34% advance over 13 months, the summer of last year up to the high we made this last month. There was no, if you looked at the Bloomberg Commodity Index, it was going down, no commodity inflation. Looked at the S&P, it was holding its own. Yes, it had a sharp sell-off in December, but basically got back up to the highs and went comfy. And then when you look at the dollar, it was firm. It had risen 2%. From August of last year to August of this year, September this year. 2%, yeah, but that is firm, but not a dynamic trend. But none of those markets offered a reason for gold to have done what it did.
Right.
Okay, we argued at that point, September 1st, aside from the possibility of a little correction, that we needed now to see one of these three or all of these three major markets have a trend change. We've defined the numbers, what we determined to be an S&P downturn, and we're triggering one of them today, but it's not the most important one. And we also determined on the dollar index, we've adjusted our numbers. It's a new quarter. We've adjusted them up, and they're not far below the market. And on the Bloomberg Commodity Index, we've got some numbers just above it that would indicate commodities are joining in. So we think it's probably best now for gold watchers to look beyond the gold pit and look beyond the gold miners and look at these three other markets because they're likely to give wind at the back of gold when they turn. Stocks turn down, dollar turns down, Bloomberg commodities turn up. So you got to watch those three markets. I think they're major sources of potential support for gold and a justification for the next upwave in gold.
All right. What about how's silver looking relative to gold? I mean, it was looking real strong.
It's just like the gold miners. It goes up more than gold, and it goes down more than gold on a percent basis. So it's like, a poodle on the leash. It runs in front of you and then runs behind you, okay? We argue, based on some long-term spread relationship between silver and gold and the momentum of the spread specifically, that silver has, in fact, broken its leash, its decline in performance over the last 3 years, that the recent surge of the last several months pushed it out enough ahead of gold where it's now saying, I want to tend to outpace gold.
Okay. All right. Okay. So with respect to the treasuries, I mean, today is a would seem to be a risk-off day. Gold's up a bit, I guess. The Dow, I'm looking at the Dow, down about 280 points. Looks like a risk-off day. Are the treasuries up a bit today as a result? Are they benefiting?
Had about a 3-point rally off the low of the day. Again, probably for the same justification that gold had a rally, and that is, okay, we got a big data point today that nobody expected, and it's scary, and it's the kind of thing that these academician types at the Fed can say, well, we're number sensitive. Okay, well, you got a number there. And it's the kind of thing that could induce them to, more cuts and possibly not even wait for a meeting.
Sure.
The question is, will the stock market have a tantrum now to force the Fed to respond to that news? Of course, if the stock market goes down, the Fed will respond, no matter what they say.
Michael, with just about a couple of minutes left here yet, the dollar, we're going to be talking to Alistair McLeod in the last half of today's show, and a big part of that will have to do with the future of the dollar in view of the growing competition that the buck has with the Chinese yuan, and the Chinese in general are an ascending power. I think most people would agree to that. But near term, as Alistair has pointed out in his essay, when we start to have credit problems, when we start to have, that is when we run into, when the credit cycle is over and we start to run into some real severe financial problems, the dollar usually gains because it is the largest, it is the world's reserve currency, the largest debts out there, a lot of short covering of the dollar, if you will. People have to go out and buy dollars to pay back the margin clerk, so to speak. But what are you seeing in terms of your dollar work right now?
Well, the dollar, again, had a strong rally from early 2018 to August of 2018. In fact, that was the bulk of the rally from a low at $88 index I'm talking about to 97, so it had a 9-point rally. And then it leveled off and continued to drift higher for the last 13 months. Right now it's about 99, so it's about 2% above where it was in August of last year. So it's going up at a snail's pace. It's steady. But our argument is if you get down in the much below the mid-97 area, so a point and a half down, you're going to trigger downside. And so all of this crawl that we've seen in the dollar, a firm tone but a crawl, will break down. And that's something we're watching because it has significance to other things. For example, if you own U.S. stocks and you're a foreign investor, you own them in dollars.
Yep.
Well, so far the dollar's not intimidated you in terms of your investment in U.S. stocks.
Right.
But if the S&P starts to rattle you and the dollar does as well, it makes the situation, it makes it even worse than simply the stock market turning down. So there's a lot of dominoes here.
Yeah, well, that would certainly make for a very rapid exit by foreigners, I would think, if both of those things hit them in the kisser, right? So
it would rattle them more than it would a U.S. investor who doesn't care.
Yeah, indeed. But the U.S. investor, but the U.S. investor starts seeing his S&P's tank and his 401k go down real hard. Wow, we've seen that happen before. I hope it doesn't, but history suggests it will, and all the trouble we're getting ourselves into with all of the debt growing much faster than income, so something's got to give, you'd think. So anyway, thank you so much for being with us, Michael. And
thanks, Jay.